Okay, good afternoon. Let's resume our committee meeting now with the next and last point in the agenda today, the exchange of views on the failure of Silicon Valley Bank and the implications for financial stability in Europe, with José Manuel Campa, Chair of the European Banking Authority, and Andrea Enria, Chair of the Supervisory Board of the ECB. So I want to welcome them both and thank them for their availability to discuss this topic with us and, all the implications of the SVB failure on financial stability in Europe. This follows last week's plenary debate. We had a debate on the same issue on Wednesday, March 15, where Mairead McGuinness, European Commissioner for Financial Services, Financial Stability and Capital Markets Union, said that the EU should stay alert after this collapse. As you know, US authorities shut down Silicon Valley Bank on Friday, March 10, 2023, as VB had its headquarters in California and was the 16th largest bank in the US, catering for the financial needs of technology companies globally. The collapse of this bank is the largest failure of a US bank since the financial crisis in 2008. Overall, 3 banks, SVB, Silvergate and Signature, failed due to liquidity problems as they ran out of cash to pay back deposits. SVB had invested in long-dated US government bonds, which lost value when the Federal Reserve increased interest rates to combat inflation. When SVB started selling bonds to pay back deposits and announced on March 8 a US dollars 1.75 billion capital increase to cover the losses caused by the sale of its loss-making bond portfolio, it took just 48 hours between the time it disclosed that it had sold the assets and its collapse. The US FDIC insures deposits of amounts up to $250,000 US. However, the FDIC received exceptional authorization from the Treasury to announce that all depositors would have full access to their funds. In the aftermath of the collapse, European banks' shares fell heavily. Today, we would like to hear from you more on the impact of these events on the financial stability in the EU and the repercussions on the EU banking sector. Mr. Enria, you have now the floor for an introductory statement of 5 minutes, and then it will be followed by the introductory statement of Mr. Campa of another 5 minutes.
Thank you very much, Madam Chair. The failure of some mid-sized US institutions revealed this month remind us that specific features of banks' business model can make its balance sheet particularly vulnerable to interest rate risk. In extreme cases, this can turn rising interest rates from a boost to profits into an existential threat. In this context, the case of Silicon Valley Bank is particularly illuminating. The institution concentrated both its lending activities and its deposit-taking activities among venture capital firms, fintechs and startups. More than 80% of its deposit base consisted of uninsured corporate deposits, which tend to be more mobile than other deposit types. Most of the bank's assets consisted of fixed income securities, which typically lose value when interest rates rise. As deposit outflows started mounting, Silicon Valley Bank liquidated fixed income securities at a loss, further exacerbating the run on its deposits and the strain on its liquidity. This happened in a US regulatory context where mid-sized banks like Silicon Valley Bank are exempted from or treated preferentially under relevant prudential standards such as liquidity requirements, the LCR and the NSFR, and capital requirements. Such banks are subject to less frequent stress tests than larger ones, and they can be allowed not to reflect in their regulatory capital the unrealized losses on securities held in the balance sheet as available for sale. The episodes under consideration have been contained also by the prompt and forceful intervention of the US authorities, which have committed to protect all uninsured deposits of the banks involved under what is known as the systemic risk exception, and set up a central bank liquidity facility accepted from banks' fixed income securities valued at par. There is no direct read-across of the US events to euro area significant banks. First and foremost, this is because the banks we supervise do not exhibit the outlier features of extreme interest rate risk and predominant reliance on concentrated uninsured deposit base, which might be termed the SVB business model. Our banks generally operate with a more diversified customer base. Although uninsured deposits are an important source of funding in the euro area as well, they tend to be more relevant for business models which are well diversified on both the asset side and the liability side, including their deposit base. Importantly, all our banks are subject to the LCR and the NSFR requirements. Liquidity coverage ratio have only decreased marginally since the monetary policy normalization process began, and they averaged in excess of 160% towards the end of last year. More than half of the existing buffers of highly liquid assets are made up of cash and central bank reserves, which sensibly mitigates the risk of mark-to-market losses when liquidity needs arise. In fact, recent data indicate that those banks that have experienced some deposit outflows appear to have succeeded in maintaining their level of excess liquidity. They have done so mostly by issuing debt securities and reducing interbank lending, and only to a minimal extent by liquidating securities. The sector's overall liquidity resilience also results from the overhaul of the regulatory framework implemented in the aftermath of the global financial crisis and the choice made by the European Union and the European Parliament in particular to apply the international standards to all the banks operating in its jurisdiction. We are well aware that the ongoing fast-paced normalization of monetary policy conditions is increasing our banks' exposures to interest rate risk. We started assessing interest rate risk and credit spread risks as early as the second half of 2021, when the first signs of inflationary pressures emerged, and in 2022 we enclosed those risks in our supervisory priorities. Last year, we repeatedly measured the sector's response to a standard 200 basis points shock to interest rates, highlighting that the net effect on bank profitability and capital is expected to remain positive under the baseline macroeconomic scenarios. The boost interest margins give to net interest income has a positive impact on banks' earnings capacity. The effect this is expected to outweigh the costs associated with worsening asset quality as borrowers find it more difficult to pay back their loans. At the same time, we also reviewed the interest rate and credit spread risk management practices of the most exposed banks and instructed them to improve the way they monitor and manage the negative impact the rising rates typically have on their economic value of equity, that is, the net present value of their economic worth, of their balance sheet. When interest rates rise, the economic value of equity falls due, among other factors, to the reduction in value of fixed income securities, including sovereign debt securities. This happens irrespective of whether banks measure the value of such securities at amortized cost or at market prices for reporting purposes. If not appropriately managed and hedged, unrealized losses on securities that banks hold at amortized cost might become a concern, particularly because investors and sophisticated depositors tend to focus on market values when their level of confidence dwindles on the back of changes in fundamentals or even mere rumors. During this review of risk management practices, we asked some banks to be more conservative on their assumptions and when the assumptions they apply when stress testing credit spreads on financial securities. We also encourage them to improve the calibration, validation, and backtesting of their asset and liability management models to make sure that these models properly reflect the loan repayment and deposit withdrawals behaviors by customers in line with the new interest rate environment. Liquidity and funding risks have also been upgraded in our set of supervisory priorities. As the normalization of monetary policy started and the phasing out of the extraordinary central banking funding facilities came closer, our supervisors began in the second half of last year to devote significant attention to the sustainability of the bank's funding plans. Both euro area banks and supervisors are therefore focusing on the risks and risk management practices that are most relevant given the fast pace of change in the interest rate environment. The market turmoil triggered by the failure of the US banks have been further aggravated by the significant drop in share prices and spike in credit default swap spreads experienced by Credit Suisse last week. While euro area banks saw their share prices tumble, their funding and liquidity positions were not materially affected, reflecting the continued resilience of the sector. Credit Suisse, a globally systemically important bank engaging in a complex refocusing of its business model, was already subject to significant liquidity outflows in the last quarter of 2022, and in order to restore trust, the Swiss authorities provided Credit Suisse with a large volume of liquidity support, and the details of the bank's acquisition by UBS were finalized over the weekend. The ECB has issued a statement welcoming this outcome, and we are clarifying in a joint statement with the Single Resolution Board and the EBA that the hierarchy of claims is clearly defined in our resolution framework, and CET1 capital would always be first to absorb losses and would be fully written down before additional Tier 1 instruments could be written down. This approach has been consistently applied in past cases, and we will continue to guide the actions of the SRB and the ECB supervision in all crisis interventions. Thank you.
Thank you very much. Now I give the floor to José Manuel Campa.
Thank you, Chair, and honourable members of this committee of the European Parliament. Thank you for this timely invitation to exchange our views. In the past days, we have been confronted with events that have raised concerns on the health of banks and increased volatility in financial markets. First, there was this crisis. There were bank failures in the US. These bank failures were idiosyncratic in their business models and affected US banks with only limited exposure to the European banking sector. A very concentrated client base with large uninsured deposits, as has been described, and lack of proper risk management have paved the way for the liquidity challenges that morphed into solvency concerns, leading ultimately to swift resolution by the US authorities. Uncertainty remains on the situation of some regional banks in the US, with proposals from the private and public sector to provide liquidity support in an attempt to stabilize deposit flows for certain regional banks. Then there was last week the situation with Credit Suisse, where here a prolonged restructuring of the bank that have had repeated risk management failures made markets and investors lose confidence. 2 years ago, Credit Suisse had already lost $5.5 billion during the Arcello's collapse, and other issues, including green seal exposures in their funds and a weakened franchise, was losing customers, raising concerns on its viability over the medium term, which materialized over the weekend. Those failures hit at times of heightened uncertainty and geopolitical risk in the macro context and major societal transformation in response to the energy crisis and to climate change needs. As monetary policy is changing course, there is no time for complacency. Over the past decades, we have faced low interest rates. Now, with a gradual increase in rates, banks were beneficiaries in the short run of this increase in rates. Their profitability increased last year as net interest income and interest margins gains materialized throughout the year. But on the other hand, as we warned, an increase in interest rates have impacted also valuation of financial assets, and expectations of potential deterioration of credit quality going forward will continue. Bank deposits have also become more sensitive to interest rate differences and become susceptible to be moved at short notice, particularly with the increased digitalization and instant communication that may easily accelerate the quest for deposit yields across the world. These issues raise questions on the viability of some business models over the last 2 weeks, and adding a pinch of uncertainty on financial stability that may then reinforce a downward spiral on overall trust. Therefore, all banks, I think regardless of size and complexity, need to manage this new environment in which rising interest rates and increased volatility is key to their macro outlook. At this point in time, we're confident that more than a decade of work has put the EU banking system in a better situation to address these challenges. Banks have better capital and liquidity positions. The regulatory framework and the single rule book has added a layer of resilience to the system, and enhanced supervision and governance provides also better risk management. The EU banking sector today shows capital ratios and leverage ratios that stand at comfort levels, with a core equity tier 1 ratio fully loaded of above 50% and a leverage ratio also fully loaded of 5.5%. EU banks vastly exceed the minimum liquidity requirements as stipulated by the LCR and the NSFR ratios, and at the EBA we're closely coordinating and monitoring the situation and exchange views with our BOS members whenever needed to assess the situation. The single rule book also provides a robust regulatory framework. The comprehensive application of the Basel framework to all banks operating in the EU further ensures the resilience of the European regulatory framework. In particular, as was already mentioned by Andrea, the Basel standards on liquidity risk, the LCR and SFR, have been fully implemented both at an individual and consolidated level in the EU banks. These contracts with the US, where international regulatory standards only apply to the most significant important banks. As we have learned with SVB, with Silicon Valley Bank, even the failure of a less significant bank could trigger a crisis of confidence with knock-on effects to other banks. And this shows that completing the regulatory package with a timely and loyal finalization of the asset package is important from my perspective. Enhanced supervision and governance also by banks has put us in a better position to assess risk in a more forward-looking manner. For instance, the sensitivity of banks to changes in the interest rates has been in the focus of EU regulators and supervisors for over a year. We at the EBA will publish a comprehensive regulatory package on the management of interest rate risk in the banking book last fall and increase our scrutiny of the way banks are managing this risk by launching a new quantitative impact study on this issue earlier this year. As mentioned also by Enria, the ECB banking supervision performed a review last year of the interest rate and credit spread risk management practices on the significant institutions in the euro area. We're currently in the middle of performing the EBA stress test exercise that hopefully will provide further evidence on the resilience of the larger banks in the Union. We have increased coverage for this exercise in the number of banks included, 70 banks, compared to the previous exercise, which only included 50 banks in 2021, and we use particularly severe assumptions in the adverse scenario. The adverse scenario puts banks to the test of high and persistent inflation and interest rates and a severe GDP contraction. It also enhances the sectoral decomposition of the scenario to more granularly stress the credit portfolios of banks. This is a stress test that focuses on solvency concerns and should provide additional clarity on the resilience of banks in an adverse scenario. Recent crises show that despite having enhanced banks' capital and liquidity positions, having a strengthened regulation and enhanced supervision, bank failures and lack of confidence may still take place in the system. We therefore need to remain vigilant and not be complacent. I would see three takeaways for policymakers and regulators from the development of the last weeks. First, upholding the confidence in a strong regulatory framework requires, as I mentioned before, to complete the pending regulatory packages. We have to implement Basel III standards fully, timely and faithfully. The completion for me also of the other pending legislative files, such as the AML package, will foster market confidence by providing better supervision and enhancing also the scope of supervision to new areas and new players, such as in areas such as crime prevention in the financial sector, and I think that will also enhance resilience. Second, as is well known, the European banking sector remains fragmented along national lines, and there is no rationale for Europe to keep the banking union resting in two pillars only. Proper risk and capital allocation need the foundation of a common deposit insurance scheme and a crisis management framework that also needs to be a strength to reduce fragmentation and divergences across the union. Finally, and likewise, the capital market union remains incomplete. Both of these large progress merit proper translation from political ambition into reality to prepare our economy for potential more volatile times to come, but more important also to address the finding needs of our future economic growth. We will continue to monitor the banks and we stand ready to provide our expertise going forward. Thank you very much for the invitation and I look forward to your comments.
Thank you. Thank you very much. Now let's start our Q&A session and we start with Markus Ferber for EPP.
Ja, vielen Dank, wenn Sie gestatten.
Thank you very much. If you don't mind, I'm going to speak my mother tongue. With the collapse of the Silicon Valley Bank, we've seen the rapid increase in interest rates can be a problem for banks. You've just explained that as well. But we've often talked about interest rates in a different connotation and with a different approach, because in the stress test in the past, it was the lower for longer scenario. So what would happen if the interest rates were low for the long term? Now we have exactly the opposite happening. And because the ECB increased it by 350 basis points and then a further 50 basis points, and as announced by President Lagarde. So I think the question is whether or not you were looking at the wrong risk, and to what extent are you looking at interest risk? And there was a very rapid reaction to the Silicon Valley Bank to calm the markets. It was agreed that the guarantee in the US 250,000 so that no one would have to be worried about their deposit. So I have two questions. Do you think that the way that the American authorities proceed is correct? Are there risks with this, moral hazard, for instance? And if they're going beyond the limits? And secondly, would that be possible in the EU? Or do you think that goes against the no creditor worse off principle? And the question is to both, of course. Thank you.
I'll start first on the issue of the stress test that you address. As you are absolutely right that this is a scenario, the first scenario in a long time, in which we are considering a macro environment of increased interest rates, increased spreads, which also have happened in the past on some fixed income outcomes, and the impact that increased scenario of interest rates has on more higher persistent inflation and lower economic growth. I think that will provide us good insights going forward. I think that the scenario is qualitatively different from all the previous ones, but at the same time, it's being I was going to say accused, but it's been referenced by many of the observers and the banks involved as the toughest scenario ever by the EBA. And I think that's probably right when we measure in terms of the GDP drop under the adverse scenario relative to the baseline. And it's a difficult scenario. I think that will help us in provide more robustness on the situation of the banks. Most of the impacts come obviously through the deterioration of credit portfolios from the deterioration of economic outlook and higher cost of lending on one part, and the other one from the deterioration of the market portfolio as assets adjustments are taking place as a result of the increase in the interest rate. Those valuation effects, which is part of what we're seeing right now, are actually quite large on our stress. So we're confident that stress should be helpful in providing some input. On the area of, you mentioned the issue of the public guarantee of the extension of the deposit insurance in the US beyond 250,000 to all depositors. This is a clause that, by understanding, I think Andrea explained that in his initial remarks as well, it can be called upon by the U.S. authorities under a specific provision for preserving financial stability. And in the current context of the EU, we do not have that clause. And obviously, as you said, there are concerns about that type of action going forward in terms of moral hazard and other aspects about what does it mean then to provide some skin in the game for people participating in the different banks and market monitoring.
Well, very quickly, because you covered it all. The first point I want to say is that the fact that we didn't have in the past the stress test focus on increasing interest rate, but it was more a low for longer scenario, doesn't mean that from the supervisory perspective, interest rate risk was not covered. We started already in 2021 to look into interest rate risk in the banking book. In particular, we have been regularly applying these standard, let's say, shocks, which are also dictated by the EBA guidelines and by the Basel standards of 200 basis points in all possible directions, so parallel shifts, tilting of the yield curve, steepening of the yield curve, and we always identified banks that were performing, worse under these scenarios and asked them to strengthen, hedge, or strengthen their risk management capacity. So there has been quite a lot of focus on interest rate risk. And on the point on the guarantee of deposits, I would say that, again, the issue is sometimes we always have the impression that we have to, map what is being done in other countries also in our jurisdiction. I would argue that the best protection for against these type of events is to prevent the type of extreme business models that we have seen being very fragile in this situation, with concentrated uninsured deposit-based, homogeneous in terms of business lines, so all fintech, venture capital investors, crypto asset providers that behaved also in a coordinated manner in this case, and extreme interest rate risk also in terms of the asset and liability management. So this, I think, in terms of supervision, is the most important priority. Thank you.
Thank you very much. Now I give the floor to Paul Tang for S&D.
Thank you, Irena. Thank you, Chair. And thank you, Mr. Enria and Mr. Campa for being here. And also for your fast-spoken contribution. That's very impressive. That's all dense. It's good to hear that you are very serious in addressing the risks, including the interest rate risk and, among other things, doing the stress testing. That's good to hear. I hope also the deposit holders of the banks will find your story as impressive as I do, because what I find striking in this situation is that it's revolving around unsecured deposits. If you look at, for the Silicon Valley Bank, but also Credit Suisse, they have very diversified business model, very different business models. Where Silicon Valley Bank had tech companies, Credit Suisse had high wealth individuals, but they started to run because unsecured deposits are the most mobile, right? So this is what they have, what they have in common. So I was wondering, what is the situation then in Europe? Because I can learn that in the US, about 40% of the deposits at the bank are unsecured. But I see that the guarantee in the US is higher, and the US relies less on banks. So is it true, could it then be true to conclude that unsecured deposits in Europe are higher than, for example, in the US? Is that a situation? And do you see this as a vulnerability in the system? Because we can refer to EDIS, but that's up to 100,000. In the US, there's a guarantee up to $250,000. And even then, you see bank runs appearing. So how do you see the situation? Is this phenomenon that we need to address as well? That the fact that there are unsecured deposits and the deposit holders try to run.
Thank you very much for your question. Let me say, first of all, let's say, the first point I want to make is that even in this period of turmoil, the liability side of the significant institution of the European banks has remained very stable. So this means that at the moment we do have a strong trust of depositors in European banks, which we think is well placed. This is not only an issue of, it's also an issue of the structure of the liabilities of European banks. As I mentioned, let's say we do have indeed quite some reliance on uninsured deposits, also in the EU. But let's say the business models, especially the business models which have more reliance on uninsured deposits, are also more diversified. So they have not concentrated uninsured depositors. They have more spread, different types, corporate, financial institutions, public administrations, and they have a better diversification also on the asset side. And smaller, mid-sized banks in general are see a higher weight of stickier retail insured deposits in their deposit base. So these are important features. Another important element is that in the US, traditionally the US are a market in which, of course, capital market activities are more developed, and we have money market funds which are being very aggressive also in their competition for bank deposits. There are two developments recently in the US which have driven this volatility of deposits. The first one is that the Fed has reintroduced the supplementary leverage ratio for the largest banks, which means that banks started to, avoiding gathering additional deposits because that would have inflated their balance sheet excessively. At the same time, the Fed has introduced provided very favorable conditions on an overnight reverse repo facility that made very easy for the money market funds to invest without counterparty credit risk at very good returns. So the money market funds have become very competitive. So there has been a major acceleration of the outflows from deposits to money market funds. This is not something that which at the moment we are seeing in the European Union. So in general, there are different structures in the markets and different structures in the bank's liabilities that I think make these type of events less likely. But in any case, let's say again, I think that our institutional setup is fit for purpose. That's my assessment, at least. I don't know.
Just very, very short comment on the fact that I agree with all the assessment that Andrea has made on the structure of the banking sector, but also very much with his analogy to the US situation with the money market facts. I think something that has potentially changed and that we're monitoring very careful as we're moving into this high interest rate environment is that over the last decade of low interest rates, there's been digitalization, there's been social media, there's been other means by which information can be spread, and within those information can be spread. Part of the experience of the last 2 weeks, it's also a potential lack of confidence and potential elasticity of deposits to move away, and that's one area of sensitivity. We have been, in the regulatory framework, we've always been prudent in Europe about what the assumptions are about potential, withdrawal of deposits in terms of the calculation liquidity ratios at the corporate level, at the retail level, but that's an area in which we need to continue to be prudent. And, for instance, we assumed in the stress test that the pass-through of interest rates to deposits, so that the banks will have to pay on deposits, is 75% for corporate deposits and 50% for retail deposits, which is much, much higher than what the evidence suggests, but it's another prudent measure. So I think that part we need to be vigilant.
Thank you. Thank you very much. Now I'll give the floor to Stéphanie Yancourton.
Merci, Madame la Présidente.
Thank you very much, Madam Chair. Thank you, Mr. Enria and Mr. Campa. The collapse of the Silicon Valley Bank raises a number of questions about the stability of our banking system in Europe. We're aware that a number of public authorities, and you repeated this, including the ECB, have already come out to make clear statements about the resilience of our banking sector. But nevertheless, this bankruptcy will have effects on other banks in the United States. As you say, we need to stay very vigilant when it comes to any potential contagion effect when it comes to our European banks. If this contagion were to take place in the EU, to what extent are European national supervisors ready to react? How does that fit together with your role as the European Banking Authority and the ECB in terms of responding? As for the important financial institutions, what are the points that you're looking at? Of course, they'll be similar to the ones of the medium-sized banks, but I'd be interested to hear about that. And then what about the national and European supervisors' efforts to maintain the competitiveness of certain sectors? I'm thinking particularly of small and medium-sized companies and tech companies. The case of the Silicon Valley Bank affected European tech companies as well. Is the European response sufficient to preserve these sectors?
Thank you for your question. On your first point, well, we know that banking institutions by construction are highly leveraged and relying on and do transformation of liquid liabilities into more illiquid long-term assets. So by construction, there is liquidity risk and interest rate risk in the banking sector that might generate also contagion. This is something that we know. How do we react? I mean, in general, of course, the best reaction is to prevent this to be triggered in the first place. So to make sure that these risks, liquidity risks, and interest rate risk are managed effectively by the banks. So that's the first thing we look at. So as I was saying before, we have started very early looking into the interest rate risk management by the banks and into the funding plans of the banks. The focus on funding plans is particularly important when the interest rate environment shifts, no? Because banks were accustomed basically to rely on very cheap funding from central banking facilities, And now, of course, this source of funding is drying up. So they need to develop their funding plans. They need to do so conservatively, and we have been very challenging in this respect. Let me say also that being in the banking union helps, because this enables us, whenever there is, there are banks with similar business models, we can read across and do peer comparisons across banks which are, facing the same type of risks, identify strengths and weaknesses, and, push the banks to adopt the best practices in the market. On the effect on tech companies, let's say we are aware, we have also heard that some tech companies actually had exposures, for instance, to Silicon Valley Bank. They had deposits in Silicon Valley banks. So there have been a channel in the European banking sector via exposures to these tech companies, but I think that the European banks have been able to easily support these tech companies to face this liquidity strain. Thank you.
Thank you very much. Now I give the floor to Claude Gruffa for the Greens.
Merci, Présidente Irénée.
Thank you, Chair. Good afternoon to both our speakers. Thank you for coming and sharing your analysis of the potential consequence of the failure of the Silicon Valley Bank and the other two banks on the European financial sector. In order to avoid such a situation in Europe, we have to avoid this happening here, and we know that since 2008. Now, a couple of questions. The SVP vulnerabilities weren't anticipated by the bank or its supervisors, largely because of the regulatory exemptions that it benefited from due to the previous President Trump's reforms. It seems that it wasn't subject to stress test, and the ECB recently launched its stress test for 2023. And it seems that the tests are less strong than some of those that are currently underway. Do you think that the scenario that's been envisaged is sufficiently demanding? And do you plan to carry out additional tests to ensure the resilience of the European banking sector? Secondly, a lot of commentators have said that the SVB was subject... if the bank had been subject to Basel III requirements, it wouldn't have gone under. Do you think that this event should lead us to reconsider deviations that we're currently seeing in the transposition of Basel III agreements in Europe? And then finally, what lessons should we be learning from this case? And also that of Credit Suisse, where the principle of no creditor worse off was not respected because the bondholders are undergoing more debt than shareholders. Are you going to take that into consideration in your upcoming risk management systems? Thank you.
Thank you. Thank you for your questions. If I may, on the issue of the scenario, the adverse scenario for the stress test that we're running right now, as I mentioned in my initial remarks, I think that the scenario beyond the narrative of higher interest rates and higher spreads and the impact that those higher interest rates will have on economic growth and economic activity, on the level of interest rates themselves, I think we're confident that both the level of interest rates are sufficiently stressed to test certainly beyond the current economic outlook for interest rates. The numbers are on the base case are obviously the projections that the ECB had at the time of the launch of the scenario, which was at the end of last year. But on the adverse case, it's significantly much larger than what looks to be now the outlook going forward, and the swap rates are very demanding. On top of that, there's also increase on credit spreads on a number of other securities, particularly fixed income securities. And as I mentioned before, there's also a significant adjustment on the evolution of certain asset prices, particularly commercial real estate, residential real estate, and equities. So I have confidence that the scenario will be sufficiently severe in that aspect. In terms of your question about deviations from Basel III, as I mentioned in my initial remarks, I think the EBA will be consistently saying that we want to stick to international rules, that we want to should remain loyal to the implementation of Basel rules within the European Union, and not just loyal in its content, but also in its timing. So I think it's important that we go forward with the timely implementation as close as possible at the Basel Agreement. With the Basel Agreement, we are stated in the past are concerned with some of the deviations, and particularly with the likelihood that's the possibility that some transitional arrangements may become more temporary. So I think in that sense, the current episode, and as you mentioned, the fact that the rules are applied to a large number of banks has also shown the value that that has in terms of the strength and robustness. Last point regarding the issue of the no credit awards of the situation of Credit Suisse, as it was explained by Andrea in our joint communique with the Single Resolution Board yesterday. We believe that under the current regulatory regime in Europe, AT1s should bear losses after core equity tier 1 has bear basically 100% of their value. So, thank you.
Maybe one small add-on to what José Manuel said. I need to be careful here because I don't want to say. But let's say, I don't want to say that this happened in the case of specific banks we are talking about, but there could be sometimes the temptation to look favorably to banks, financial institutions, which are investing particularly in new technologies, in new instruments, and to experiment with these sort of new innovative instruments. And there could be the temptation to say, okay, to let these models flourish, let's maybe make the regulatory or supervisory requirements for these banks a little bit less demanding. I mean, I think I'm very supportive. I think that we need to let our banks also invest in new technologies. They need to do so. I want to have new fintech companies becoming banks and maybe challenging the incumbents. But if you are a bank, you need to be regulated and supervised as bank, and you need to be strict in the application of the requirements. And I think this is an important principle that we need to keep in our let's say, in our attitude towards supervision going forward. Thank you.
Thank you. Thank you very much. Now I give the floor to Gunnar Beck for ID.
Thank you very much, Mr. Campa, Mr. Enria. I've got two questions to both of you. First of all, SVB failed, and it was one of the most important lenders to tech starters. Now through the NGEU, billions are being invested in tech companies as a future market. But what happens if the tech bubble bursts? The SVB does not seem to have been one of the most profitable and successful banks in the world. So how does the ECB and the EBA model the kind of risks of the bursting of a technology bubble? Secondly, SVB and Credit Suisse was run by political correctness and incompetence. The SVB's chief administrative officer, Joseph Gentile, was a CFO at Lehman Brothers until it went down in 2008. It was also involved by Arthur Andersen, which is the accounting firm that was wound up after the Enron crisis. The CEO rushed off with his private jet to Hawaii after having sold off all of his SVB shares just before the bank went under. So we urgently need a discussion on the impunity of these banksters so that this does not repeat itself in Europe. What have you done specifically since the financial crisis and the Eurozone crisis to ensure that our savers, pensioners and investors are safe from incompetent managers and ensure that they are ultimately accountable for their actions? Thank you.
Just, I think part of the regulatory framework that has been built over the last decade has made what I would say a fair amount of progress in trying to enhance both the methodologies that we have and the regulations that we have on governance, on fit and proper assessments, on making sure that the members of the management body and the executive body are assessed properly. I think there are challenges still there, and I think as we go through the revision of the CRD, we might want to enhance that process a little bit, but also beyond that to also align risk objectives in a better manner and go with compensation of managers going forward on assessments. So now we have compensation requirements in the European Union that put limits on the rates of fixed remuneration versus variable remuneration, on the amount of variable remuneration that should be received, also linked to or aligned with shareholder incentives, maybe linked to stock performance, on delayed payment of some of the variable remuneration over a number of years, depending on the seniority of the institutions, and as well as the possibility of having clawbacks or maluses to be applied in situations in which exposed there is bad outcomes for the institutions that they manage, so that some of that delayed remuneration can be clawback. So those are mechanisms that I think are in place and actually have been already imposed in some cases in the European Union. I think in the past, when I think, for instance, on the resolution of Popular, I think there was some clawback, some of the compensation that was taken there. So we do have some mechanisms that hopefully will help align incentives and enhance better governance of the institutions.
You mentioned a tech bubble. I don't know whether we have a tech bubble, but let's say in general, the main issue, the main contribution that we can give to any development of bubbles is to make sure that the credit risk controls are in the proper place at the banks, and that the banks do not inflate these type of bubbles by relaxing lending standards towards certain type of counterparts. And I can tell you that in the last years, in particular, starting during the pandemic, we've been very alert to look at the sectors that were particularly risky, because maybe they were hit by the pandemic or because they were, hit by the energy shock or any other type of events, and we have done quite granular and in-depth analysis of the risk controls of the banks vis-à-vis these exposures. On governance, let's say, José Manuel said it already. Let me say that you say, how can we be safe from incompetent managers? I mean, the most important, let's say, protection, that safeguard that we have is the fit and proper regime. And here is the vetting by the supervisor of the professional capacity, the skills, the knowledge, but also, let's say, I would say the ethical compass of bankers. So we know you have the banking package on your table. We have strongly argued in favor of a strong, let's say, and harmonized and fully harmonized framework for fit and proper that could enable the supervisor in all member states, so in all the banking union, to do demanding ex-ante assessment of the managers and members of the board, and ensuring competence and professional skills across the board, also with diversity of professional regimes. We need to have a robust challenge in the board. We are doing this year a review of board effectiveness, which means the ability of the board to really challenge the management and have checks and balances within the work of the banks. I think that's the most important safeguard. Thank you.
Okay, thank you very much. Now I give the floor to Michiel Hugefan for ECR.
Thank you, Chair, and thank you, Mr. Enria and Mr. Campa, for coming to the European Parliament. Things have moved very quickly from the failure of the Silicon Valley Bank. Now, I initially thought I would ask you some questions specific to the failure of SVB, but then we were all concerned about Credit Suisse last week and over the weekend. While SVB and Credit Suisse are not directly compared or related to each other, I do think we see some overlap. The key reasons why both ultimately failed include three main reasons, and the first is the failure at the board of these companies. Incompetent and failed leadership where SVB was guessing too long on these low interest rates, while there were clear indications that these interest rates were going to rise. And obviously Credit Suisse involved in multiple scandals. And the second reason is multiple omissions and failures by the regulators. The SVB was already on the list of many analysts as a potential risk, and Credit Suisse was already seen for a long time as a car crash moving in slow motion. And the third item I would like to address, and I think that's also very important to address at this hearing, is the failure at the top of our own policymakers and public institutions, who have continued to pursue free money and reckless spending policies for more than a decade. That is the root cause for the 40-year high inflation we are facing right now and the sharpest rise in interest rates we are seeing in more than 30 years. And we know that tackling inflation seldomly goes with a soft landing. So in a matter of a couple of short weeks, we have gone from a US bank catering to startups, coming to a threat of a potential financial crisis in the EU. And my question is then relating to such potential crisis. My question to you is, given the information available today, what risks do you imagine the failure of SVB and the acquisition of Credit Suisse to have on the European housing market? How will this news affect European citizens' ability to acquire loans? And what about the willingness of banks to open credit lines to businesses and consumers? Do you foresee potential underlying inflation caused by this crisis hurting potential homeowners in the short or medium term? Thank you.
Thank you. I think that our assessment so far, and obviously it's been 2 weeks since the turmoil of the last two, but in terms of what the impact has been in lending activity and availability of credit across the board of the European Union, is that we have not seen really at this stage any significant concerns. So when you're concerned about what is the impact of this in terms of lending to households or to SMEs, I would say that at this stage maybe it's too early to judge, but I would be prudent on saying that there's any evidence right now that there is any impact. On that aspect, it is fair to say that within our risk assessment, when we think about the European Union, credit markets right now, one of the areas of risk concern as we're going forward that we have been monitoring was real estate markets overall, mortgage mortgages, particularly commercial real estate and household real estate in some parts of the Union. But in terms of additional provision or potential credit crunch, and here obviously the supervisor has much more intense up-to-date daily information, but my impression is that there's no significant impact on credit provision.
I mean, I wouldn't add a lot. I mean, in terms of the tightening of monetary policy, what we are seeing is that, let's say, the developments are so far according to the expectations. So as the tightening has started, we have seen a continued growth of loans until Q3, basically, of last year. Then in Q4, the bank lending survey of the ECB has started highlighting a tightening of lending standards. So banks were expecting to, let's say, tighten lending standards, apply, higher interest rates to customers and being more selective, which is what the transmission channel of monetary policy is about. At the moment, this is proceeding in an orderly way. As I said, in terms of the impact, I mean, José Manuel said it already, in terms of the impact on the housing market, we have been doing already last year a targeted review and then on-site campaigns of inspections on exposures to commercial real estate, identifying, of course, where there were problems in terms of valuation of the collateral, in terms of origination standards, in terms of credit risk management, and we are now repeating the same campaign of on-site inspection and the same targeted review on residential real estate. It's clear that when you are moving from a low interest rate environment to a, let's say, to higher interest rates, these are markets that could go under greater pressure. So you need to make sure that banks have their credit risk monitoring in the right place, that when they see signs of deterioration on the side of the customers, they preemptively get in touch with the customers, trying to restructure the loan, trying to make, to address the problems as early as possible. This is the lesson also of the last crisis, and we are trying to apply all the best practices that we have identified in order to follow closely the development of credit risk in these markets.
Yes, now I give the floor to Chris McManus for the left.
Thank you, Chair. And I suppose an awful lot of this talk about bank collapses, worries us all, and it does really concern many people who remember how talk about banks far, far away being in difficulty turned into a very real and brutal austerity for millions of people. And of course, we all hope that what we're dealing with here is to some extent an isolated incident, of course, but we do need to be vigilant. I recently became aware of what I would call, in hindsight now, a particularly badly timed report that was commissioned by the European Banking Federation from earlier this year. And in their foreword, the EBF states, when they were looking at why US banks are so much more profitable, and I quote, "The regulatory and supervisory pressure EU banks are exposed to play important roles." And that, and I further quote again, "Financial regulation has a direct impact on the banking sector's ability to support the real economy." So it was all basically saying that regulation was bad. Now, my question to our two contributors, or rather an invite to comment, is it their opinion that the Euro system and the EBA should prioritise financial stability and protection of the taxpayer above any other political agenda? And would they agree that to even suggest rolling back regulation should be given quite short shrift, and that any loosening of regulation most certainly should not be on the agenda? And a second query, not immediately related, but SVB was a lender to many tech companies, and it was also connected to the world of crypto assets. And I'd ask, what analysis have our contributors got, or would they consider carrying out, into how vulnerable European banks might be to any further crypto collapses? And what would be your advice to any EU bank tempted to invest in such assets? Thank you, Chair.
So, you ask on the question of how the interrelationship that some of these failures, particularly in the US, have had with the crypto markets. I think that's an interesting part that we need to assess carefully, because it is true that there were a large, because of their specialization with high-tech firms, there was a large exposure of some of the crypto industry to these banks. And on the other way around, I think there are lessons there to be learned. And fortunately, in Europe, we have the MiCA regulation that we're now in the process of starting to implement. Once it has been approved by the co-legislators, I hope we are going to, I hope we will implement it properly, I meant to say. We are assessing precisely, what is the interrelationship of this, particularly when we think about some of these crypto assets as being payment devices similar to e-money institutions, and what are the proper regulations that should be considered into them in terms of the reserve requirements, where those reserve requirements should be put forward, and what is the prudential measures that should be analyzed. We're on the early stages of developing the relative technical standards journey with ESMA in this process, but I think that's actually some lessons that we need to assess going forward. It's an important aspect. As I said, I think we're in a better starting position than the US because we have MiCA in place. And overall, I think that's a better position. As you know, in terms of the second part of your question, what should be the attitude that we have, or the approach that we have about banks holding this type of assets? Our approach so far has always been that these are assets that are difficult to understand in terms of their underlying business model for many of them, that they're highly volatile, so the banks should be very prudent in holding them. We recommend not to hold them, and at the same time also not to market them to potential customers in their advisory work. Basel has moved forward with some principles and standards on how to include some of these crypto assets into the bank's balance sheet in prudential standards. There was some agreement that was reached in December, and some area in which, as we go forward in Europe, we need to consider translating and implementing, which basically distinguishes between two types of crypto assets. Crypto assets that are backed by good assets, let's call more broadly defined as stable currencies or stable crypto assets, and other ones that are not backed up, they're more speculative. In the second case, the treatment overall should be basically a deduction if banks want to invest on those assets. In the first one, depending on the characteristics of the assets and qualities, the treatment may be somewhat more favorable. But that's the progress that has been made in that part.
If I may, a couple of words on the European Banking Federation report. I would like to take more time, but I don't want to be. It's interesting, no? Because basically what the European Banking Federation report did was to compare the capital ratios of European banks and US banks. And the conclusion was that we were tougher than our US colleagues. And this was basically a competitive disadvantage for our banks. No? So that was, in a nutshell, the main. This when I first read it, I thought, this doesn't resonate with me. We meet frequently with our colleagues at the Fed, and we compare, let's say, the capital ratios, the treatment of our large banks, and my perception has always been that we are in the same ballpark in terms of capital ratios, the UK being a bit higher because they rely more on the counter-cyclical macroprudential buffers than we do. Then digging a bit deeper into the analysis, you understand that they take all the euro area significant institutions, so 113 banks right now, and the larger sample of US banks. So while indeed on the global G-SIBs, let's say the global systemically important banks, we are basically in the same ballpark as our US colleagues, or maybe even a bit lighter than our US colleagues. It is true that we are much more demanding in terms of capital for the banks of lower size. So the US have done a very dichotomic approach. No? They were very demanding in terms of buffers for the especially through the CCAR, the stress test for the largest banks, but much less so for the lower banks. And to some extent, what we have been discussing today is also reflecting this bifurcated approach that they adopted. The other points in the report, let's say that we are excessively heavy-handed as a supervisor. I tend to disagree, as you can imagine, with these comments. But of course, let's say we also have to take some positives, let's say, and we might. It might be true that we, in terms of procedures, let's say, we can be a bit lighter. Sometimes we are also thinking on how to become lighter on procedure, but definitely not on standards and not on the intrusiveness, on the rigor of our supervision. On this, I don't think that there is anything that we need to change. Thank you.
Okay, thank you very much. Now I'll give the floor to Isabel Benjumea.
Thank you, Chair. I will continue in Spanish. Muchísimas gracias.
Thank you to Mr. Campa and Mr. Enria for being here today. As I said previously, on the 10th of March, we saw the biggest banking failure since the Washington one in the United States. Now, fortunately, the repercussions for our markets have not been similar to those that we saw with Lehman Brothers. Nonetheless, the intangible effect that it might have on our continent is that we have finally realized that the banking union, hasn't been completed 11 years after it was started. only 2 out of the 3 pillars would be ready to act if something similar were to happen as what happened in America. If there were to be a parallel banking crisis as well as national deposit systems, that would lead to stumbling blocks for member states. And so I'd like to know, what more do we need to happen before we can make progress? Are there any technical issues that aren't allowing us to complete the banking union beyond the political issues that we know? Is it going to take a crisis for us to finally solve this? Finally, European SMEs are more dependent on the banking system than the big companies. 70% of SMEs are dependent on their banking funds, unlike 40% in America, where they're much less dependent. The European SMEs have much worse conditions for their banking financing as well. So they have a certain number of tools that they need to be able to use. The Silicon Valley case shows us that we have to ensure that our SMEs are no longer so dependent on a single source of financing. So I'd like to ask you, what are the perspectives of the European Banking Authority in this area, and what can we do to ensure diversification of financing for our businesses from the perspective of your institution? Thank you.
Thank you for the question. I think that I share many of the comments that was there at the beginning, and I think I mentioned that in part of my concluding points on the initial remarks. I think that we should remind ourselves that we have an incomplete banking union. We should remind ourselves that that incomplete banking union has implications in the short term for a functioning of the single market that is not integrated. As a result of that leads to fragmentation, that fragmentation also leads to limits in risk sharing, and also to difficulties, obviously, in facilitating growth, potentially in the medium and long term. We have put forward a number of suggestions in the idea that the banking union should continue. I think it's not just the banking union. As I said in my initial remarks, I think it's the complementarity of the capital markets union, as you mentioned as well on your initial remarks, on your question regarding the availability of different alternative sources of funding for small and medium enterprises and for equity investments going forward is an important aspect. And I can only encourage that we continue to work in that direction.
I mean, let me add one point to what José Manuel said. We do manage crises, and we can continue managing crises without EDIS, without a complete banking union. So we don't have a dysfunctional regime. The point is that, the way in which we do that is very complicated. I mean, every time, and this has been the experience in recent cases, in Sberbank, also not a liquidation case, but still an exit from the market, RCB in Cyprus. In any case, we are confronted with different features of the national regime. So if you compare the European Union with the banking union with the US, we do have the same amount of funds. If you take together the Single Resolution Fund and the National Deposit Guarantee Schemes, we are in the same ballpark as the FDIC in the US. But it's very difficult for us to deploy this funding to actually ensure a smooth management of a crisis, because we have, in any case, different regimes at the national level, different engagement of the deposit guarantee scheme. So what is crucial in a crisis is the funding. And having a more integrated system would make our life much easier, and I dare say also the life of savers, depositors, and citizens. Thank you.
Thank you very much. Now I give the floor to Marek Belka.
High inflation, which is, in my opinion, increasingly homegrown, requires higher interest rates. And higher interest rates have consequences for the financial stability something that we have overlooked so far, slightly at least. So the question first to José Manuel Campa. The recent experience, will they prompt discussion about our regulatory regime? And what I have in mind is, number one, the eternal problem, the overdependence of commercial banks in Europe on domestic sovereign papers. And second, which surfaced in one of the cases in America, it's the maturity mismatch between liabilities and assets. Do we need some kind of deepened discussion on this, maybe strengthening of the regulatory regime, although I hesitate to propose anything like this. So this was for José Manuel Campa. Two short questions for Andrea Enria. Does the recent experience and the consequences of increasing interest rates have any impact on the functioning of TPI? Maybe surprising link, but well, now we may be forced to take into account financial stability risks in assessing Euro member countries, which makes the whole process even more complicated. And the third question, also for Andrea Enria, do you see potential spillover effects of the rate hikes in the Eurozone for non-Euro countries?
Thank you. Thank you for the question. I'll start and then you. So on the question that you addressed to me on the issues, particularly on the high interest rate environment, and do we need an enhancement of the regulatory framework, particularly the area of interest rate risk in the banking book, and the sovereign exposures, particularly the home bias of the sovereign exposures. I would say here, that obviously this is part of a long discussion, but on the interest rate risk of the banking book, as I said in the initial remarks, and we've been monitoring as well, and some of what we've been discussing in some of the responses, this is being an area of enhanced monitoring, and we put forward a package of regulatory of technical standards and guidelines in October that take into account the supervisory outlier test, that take into account prudent regulations in terms of what the assumptions that we put about deposit outflow, like I mentioned earlier, and other aspects of the management of the interest rate of the banking book on the banks. On top of that, we put forward a quantitative impact assessment at the beginning of this year. We had done an impact assessment before we put forward technical standards to assess the value. But given that the interest rates are rising faster and maybe even higher than expected, we had to do a new impact assessment. And we're in the middle of doing that right now. In the aspect of the sovereign holdings, I think that this is obviously it's being and continues to be an area of concern. Our view has always been that it's better to have these portfolios managed according to the risk that they have implicit, not at face value. And beyond that, also there probably some concentration concerns. Concentration risk is a concern, and some concentration charges or limits may be a good way forward, because at the end, when we think particularly about the banking union, it's not the same to have a portfolio of a given size of sovereign bonds of whatever the size is of 200 of sovereign bonds of Euro area member countries, if those 200 are from a single member country or from all 27 member countries. The interest rate risk diversification of that is probably the same, because they're all subject to the same interest rates and monetary policy, which is the ECB, but the diversification aspect of that portfolio is quite different depending on whether it's on one single national bond or national member state versus a diversified portfolio. So I think that encouraging that diversification will be good also for the banking union.
Thank you. Well, of course, it's difficult for me to reply on TPI, which is on the other tower of the ECB. What I notice is that, let's say, in this very fast-paced increase on interest rates that we had since July last year, let's say the spreads between different countries, between different sovereigns, have moved very little, even in the turmoil of the last days. This, for me, is a blessing because it enables me to focus on the interest rate risk of banks, irrespective of the flag that they have on their headquarters. So, in a sense, to look into their internal risk controls more than on the more general macro environment. So I hope that this remains the case. The issue of I think also, however, let's say a point I want to make is that banks use, let's say, government securities predominantly as high-quality liquid assets, for their liquidity coverage ratio, so as a liquidity buffers to be used in case of stress. This liquidity buffer is correctly accounted at market value. So you need to look at that at market value. But banks might still have these assets in accounting books held at amortized cost, which means that if they actually sell them, they would need to take capital hit if they are, of course, undervalued, if they lost value due to increase in interest rates. So that's a little bit of an issue as I see it. I've been arguing since a long time that ideally one should have, and this is maybe for you to consider, legislation that says that if you want to account, I know it's a bit technical, but it's important for me. If you want to account something for a quality liquid assets for the liquidity buffers, you need to be ready to sell this asset in the market anytime you have a liquidity stress. So in my view, it should come from accounting books that are mark to market. And that, in my view, would be an important improvement in the framework. On the spillover effects between Eurozone and non-Eurozone, let's say, I would say I don't notice anything in particular. Unfortunately, to be honest, we do have a banking market in the banking union, which is still a bit segmented across national lines. So we don't have a lot of pooling of liquidity or massive, management of across all the banking union. So these dynamics remain a bit national. So you see countries in which you have a huge spike in interest rates, you see a huge increase in interest margins and in profitability. You would expect that in a banking union you would see, dynamics by means of which maybe other banks start entering that market. There is more competition. These are actually dynamics that unfortunately we do not see. So there is very much national dynamics, but I don't see spillover effects. Of course, there could be some spillovers in terms of risk if the risk management is not done properly, but let's say the interest rate risk in cross-border groups is deeply integrated, so I don't see a problem from that side. Thank you.
Okay, now we have only 5 minutes left, and I have 3 requests for Catch the Eye. So I suggest we collect the 3 questions, and then I give you the floor for the answers. Otherwise, we will not make it, and I would like to give the opportunity to all the 3 requests. Ludek Niedermayer, Jakeliunas Mavridis.
Thank you very much, Irene, and thanks our guest for very good discussion. I'm going back to interest rate risk because Silicon Valley Bank, this was kind of classical banking failure from old time, suffering with interest rate risk and refinancing risk. I'm grateful that you are talking about using of stress tests quite a lot. I guess it's a very helpful tool. Obviously, in a refinancing risk, it's more complicated. But going to my question, I'm referring to what Marek was talking about. due to really substantial increase of long-term rates, somewhere in financial system there is substantial loss on mark-to-market value on long bonds, because there is huge amounts of long bonds or fixed rate long-term assets. So I wonder if we are really confident that we know how much is in the banking sector and how much is elsewhere. Because this was, and I very appreciate what Mr. Enria just said a few minutes ago. This is some of the concerns. There is huge amount of mark-to-market losses because the yield went up like 200, or in case of US 300 basis points. So if you multiply it by duration of long-term bonds, these are substantial money. So my question is if we have this risk under control. Thank you.
Thank you, Chair. Let me go back to the problem. I see it as a problem, variable interest rates, mortgage rates specifically. We talked about that, Mr. Campa, with you last year, I think. But in these times of, stagflationary pressures and uncertainties related to the war in Ukraine, there could be developments in the markets. Collateral values, real estate values in some segments of the Union could be falling down. Would you see, especially since Mr. Enria is here, that this could be a problem not only for the mortgage takers but also for the banks, as was the case, I think, with the subprime mortgages back in the US in the previous crisis. So there is this asymmetry of prudential supervision, which is there is rule book, SSM, etc. But there is nothing on the European level as far as the business conduct supervision, and especially consumer protection in mortgages is concerned. Would you think that this, would take a more regulatory approach from us, from you, from others, that there would be no interest rate transfer into mortgage takers? Because I think this is a problem, remains a problem, and could materialize in some problems for the banks as well. Thank you.
Thank you, Madam Chair. I find this discussion that we had today very interesting for one more reason. The fact that it's taking place with somewhat relief. But that is something, I want to get your response on it. Completion of the banking union, and it is taking in consideration the fact that the decision of the US regulatory authorities to step in and safeguard all deposits, not only those covered by FDIC, but all deposits, including the non-guaranteed deposits, which, by the way, are more than $250,000 US. My question is very simple. Are there any lessons to be drawn for us in the Eurozone regarding the deposit system? And my second question, how would you respond to a Cypriot depositor who in 2013, unfortunately, suffered through a very vicious deposit haircut? Does size of the banking union matters after all? Thank you. And I would expect your frank response.
So thank you. Before giving back the floor to our speakers, let me remind that we have 10 minutes extra interpretation, so we can allow for to conclude and have all the answers. And I want to thank the interpreters for the valuability. Yes.
Thank you. Thank you for the questions. If I may first, Mr. Neumayer, on the issue of you're absolutely right that the way and Andrea made a reference to this as well, with the accounting is being down of the positions of fixed income portfolios in general in the banks is different depending on the business model, the purpose of that. It's also true the banks need to manage interest rate risk in the books, and one way we can manage interest rate risk is by acquiring fixed income securities. So it's important to look at the assessment overall of the sensitivity of the bank's business model, not just individual positions to the interest rate movement, and that's why there's been so much emphasis being done on interest rate risk on the banking book. I think, and what that's implied for liquidity, banks would, in general, many of the assets that they hold to maturity, the purpose is precisely to do the interest rate risk management, and to the extent that they will not need it for a liquidity stress, it's likely to maintain in the books, so it's likely to be good until the payments are due on those securities, and the mark-to-market performance is less relevant. But nevertheless, it's an area which we monitor, and the supervisors as well monitor very closely. Mr. Jalinas, I think your question is well taken. I think that the area of consumer protection is an area in which we can enhance overall at the European Union. We have, actually we're doing a peer review on a particular area of consumer protection, which is how the competent authorities assess, the consumer protection authorities assess the behavior of the treatment of customers under arrears and what banks' actions are taking in the different countries. We'll have the outcome of that in the next month, so I'll be happy to share that with you. I hope that's a step going forward. Our mandate in general in consumer protection, obviously as an EBA, is much more weaker than the mandate that we have on prudential purposes. On the last question, as we discussed at the beginning on the issue of deposit, I think that the actions taken by the U.S. authorities is possible within their tools. It's an issue that raises significant concerns of moral hazard going forward, but at the same time, it's an issue that I think is less relevant for many business models in the European Union, because the extreme situation of the business model of the bank that was intervened, where there was 94% of the possibility that was unsecured, it has such extremes is now present in the current European, at least across the significant institutions in the current universe of European banks. So it's unlikely that it would be a similar situation taking place.
Well, on the point of mark-to-market value, let's say I said what I think on the liquidity buffers. Let me say also that, let's say, in general, I don't like the term unrealized losses, because it gives the impression that something is hidden under the carpet, and is not visible. Actually, banks are requested to do Pillar 3 disclosure. So if you go to their books, you can see exactly how much the market valuations of these assets would be, and how much would be the impact on their capital position. So that is something that is in the open. And indeed, let's again, if you take our banks, many of them have their liquidity buffer, which is composed for more than 50% of cash and deposits, reserves at the central bank. So in a sense, they could go a long way before having to realize these losses. So, and if they keep these assets in their balance sheets until maturity, there wouldn't be any loss at the end of the day. So let's say the issue is let's say we shouldn't overemphasize the issue that there are huge market losses hidden in the bank's balance sheets. This is not the case. First of all, they're not hidden, and second, let's say the composition of the buffers are such that they can go quite a long way before having to sell let's say, assets and realize these losses. But still, I think you have a point in this, and as I mentioned before, we should make sure that, at least what we ask them to hold to be dealing with the market stress needs to be carried at market value, because they need to be ready to sell it at any moment without getting a capital hit. On the point on mortgages and conduct, José Manuel has already replied. Let me reiterate that we are conducting a specific thematic review on residential real estate, on mortgages, and again, looking at the bank's practices, their risk management. We don't look at the conduct, but indeed, let's say, we also see if there are improper refinancing or, type of behaviors that are not compatible with sound risk management practices, and we would definitely raise these issues to our banks. On the point on EDIS and the safeguards of deposits, again, as José Manuel also said, I think that first of all, the best safeguard for depositors is to make sure that they have no reason to run, so that we don't have business models which are extremely, exposed to some risks. And in general, I don't think that we should, change the framework that we have right now. So I know that the haircuts applied on Cyprus depositors in the past have been particularly harmful. We see still today, supervising Cyprus banks, how much, inducing volatility in the potential behavior of depositors can destabilize the banking sector. So I think that when these tools are applied, you need also to always to be very wary and careful about the consequence that this could cause in future. So that's a very delicate topic, and we are very much aware of this issue. Thank you.
Thank you very much. Now we have concluded our public hearing. I really want to thank all the participants, and in particular our guest speakers, José Manuel Campa and Andrea Enria, for their availability, their frankness, and I think this is also an important signal that in situations like this, the Parliament is the house also of transparency, and we let everybody know, and we inform the citizens. Thank you very much. Have a nice evening.